And here are some interesting facts to solve for agency problems. Well, they make sure the companies make sure the managers' interests are aligned with shareholders. So they will design compensation package in relation with the firm's performance. In other words, if the firm stock price goes up, the managers would get paid higher. So this would be called compensation plans. One is based on incentive, which is based on granting of stock options. As I mentioned earlier, when stock price goes up, the options price would also go up. Another plan is performance plan. So they make sure the manager's compensation is related to the earning per share or the stock performance. So if the performance is better, then they get more bonuses and more pay. However, in reality, you see that these major companies have their CEOs with millions of dollars annual payment. However, the stock return is not that impressive, especially for Larry Ellison, who is the CEO of Oracle Group, and the stock basically declined by 22% in that year of 2012, but he still get $96 million payment. So if you observe the numbers here and the numbers here for compensation and returns, you will see the interest is not really aligned. So here are some other agency issues. So when a firm internal corporate governance structure is unable to keep the agency problem in check, so it is likely that rival managers will try to gain control of the firm. If it is that case, then the shareholders will threat to make the firm taken over or acquired by another firm. So if a firm is taken over, then most likely the managers will be completely replaced. So the managers will lose job. So that's how the shareholders would get rid of the managers if they do not listen. What about the shareholders' wealth? Well, in most of the takeover cases, the firm being acquired or being taken over is usually having a large increase in stock prices. For example, in 2003, when Adidas took over of a Reebok, Reebok's price increased by 33% when the announcement was made. So after addressing the agency problems, let's now talk about the business ethics. So the business ethics are standards of conduct or moral judgment that apply to persons engaged in commerce. And it's not just the agency problems in which the managers waste money of the company, of the shareholders. It could be in many other aspects, and some of these aspects could be related to fraud. And the violation of the standard finance involve a variety of actions, like creative accounting. Basically, this is about cooking the book, faking numbers, or providing false information. And they do a misleading financial forecasts, and also insider trader, which is a no-no in the world of finance. They do fraud, corporate fraud. Basically, that means deceiving people, and also pay themselves a big fat check in terms of compensation. And they also do a bribery. That's definitely a form of corruption. And also kickbacks. Kickbacks basically means the CEO hire another company to do work for his own company, and then he receives some benefits from the company in secret. And also there is a negative publicity leads to negative impacts of the firm when any of this violation happens. So the government regulation generally shapes the corporate governance of all firms. During recent decades, it received a lot of attention in the academic world and also in the practical industry. And nowadays, a lot of crimes are prosecuted. So that's a pretty important topic today. The how issue raised back in 2002 when the big company Aaron got in trouble. That was an energy company. It was ranked #1 on the Forbes magazine. What happened was the CEO of Aaron did a lot of bookkeeping, falsify accounting information, providing misleading forecasts, and then the company eventually went bankrupt. So that was a pretty big shock in the U.S. history. In reaction to that, U.S. government passed this bill called the Sarbanes-Oxley Act. It was done in 2002, right after the collapse of Aaron. And not just Aaron, but also some other big companies of the United States, like a Texaco, like WorldCom, and all these giant U.S. companies. So in this bill, the law forced the company to establish a oversight board to make sure the accounting is in place, all the numbers are correct. And also they tightened the rules of auditing to make sure controls are in place. If the CEOs are committing corporate crimes, make sure they got punished. And also they strengthen the account disclosure requirement and make sure the corporate officers, not just the CEOs, but also the CFOs, COOs, follow the ethical guidance. And there are many other changes, including establish a corporate board structure and membership guidelines. And also, if there is a conflict of an analyst in terms of recommending a firm, then that analyst has to follow the guidelines designed by this bill. And also, if the corporate insiders who get paid with company stocks, if they sell the stocks, it will be related as defined as insider trading. However, there's an exemption for this kind of insider trading, as long as they make instant disclosure of their stock sales. And also, there's security regulations for auditors and investigators. So, after introducing all this stuff, let us do some practice here. A business owned by a single individual is called HBB, sole partnership, right? It's by one single individual. This is a pretty easy question. Which one of the following statement is correct concerning the organizational structure of corporation? Well, if you look at the chart I mentioned earlier, you probably get a good idea of how the organization is structured. So first, the vice president report to the board? No, the vice president reports to the CEO, no matter it's the VP of finance or IT or human resources. B, the CEO reports to the board of directors. This is the correct one, all right? C, controller reports to the president? No, the controller and the treasurer reports to the CFO or the vice president of finance. E, the chief operations officers report to the vice president of finance, and this is wrong. Both of them reports to the CEO. The next question, the primary operating goal of a publicly owned firm interested in serving its stockholders should be? Well, you can see a lot of answers here, and they all look pretty nice, right? Some of it is about maximizing the corporate income, earning per share, minimize the losses. Well, the true answer here should be D, maximize the stock price per share over the long run. Okay, that's very important because the stock price resembles the interest of a shareholder. And it has to be over the long run because if you just maximize stock price on a specific date, like option E, then there could be a lot of manipulation, fabrication. The managers can waste the firm's long-term resources just to window dress the short-term high stock price. So it has to be long-term, the bottom line is that. All right, the next one. Which of the following statement is correct? One advantage of forming a corporation is that equity investors are usually exposed to less liabilities than they would be in a partnership. Well, this is the correct one, okay? So A is the one we should select because corporations are having less liabilities compared to partnership. For practice purpose, let's just go over all the rest options. B, corporations face fewer regulations than partnerships. That's wrong, because corporations are facing more regulations, especially the regulations of corporate laws. C, one disadvantage of operating business as a proprietor is that the firm is subject to a double taxation because taxes are levied at both firm level and the owner level. Well, C is incorrect because double taxation only applies to corporations. D, it is generally less expensive to form a corporation than a partnership because with a partnership, extensive legal documents are required. Well, it's wrong because partnership is less expensive than corporations, and also it requires less legal documents. E, if a partnership goes bankrupt, each partner is exposed to liabilities only up to the amount of his or her investment in the business. So this is incorrect because for partnerships, the liability is unlimited. What that means is if the firm goes bankrupt, then the partner has to pay all the liabilities, okay, all the liabilities, not just up to his or her investment in the business, but to whatever the liability it is. All right. So after the practice, let me just introduce a little bit of the functions of managerial finance. So the managerial finance is getting very important, and for small firms, it's generally performed by accounting department. And as a firm grows to a larger size, there could be a separate department just to take care of the financial job. And this separate department could be related to the CFO, the Chief Financial Officer, who reports to the CEO or the company president. And in the world of finance, it's pretty close to finance is pretty close to economics because the financial managers must understand the meaning, the economic meaning of their activities, and also the change of economic policy have certain applications from finances, and the financial managers has to be aware of that as well. So the most important analysis here is the cost-benefit analysis, and we all know that in order to a firm to survive, the benefit has to be greater than the cost. So if I give you an example right here, this company and also there is a old computer playing a role here. So if they just to get a new computers, they would get benefits from it. And if they replace the old computers, they basically are abandoning the benefits from the old. So there is an opportunity cost for replacing a new computer here. So the cost to the new computer here is $8,000, and there's also proceeds from selling the old computer. So the marginal cost of it is actually $6,000. So you spend $8,000 by buying a new computer, and then you get $2,000 by selling the old computer. So that's your marginal cost. And this is your marginal benefits for replacing the old computer with the new, and then this would be your net benefit. So when it is a positive, you just go ahead and take the project. And there's also a lot of overlap with accounting. So the firm's finance and accounting activities are closely related. And for a smaller firm, as I mentioned earlier, is usually the accounting department take care of the financial job. And the major difference here is the finance focused on cash flows, and the accounting focused on the numbers on accrual basis. So in your accounting class, you probably have learned what is a accrual basis, what is a cash basis. So if the sale is generated, okay, If the company say I sell certain products and they are going to pay us $100,000, although they have not received $100,000, they just put that revenue on their accounting statement. All right. But in the finance, as long as the cash has not arrived yet, that revenue has not been transferred to the company account, then there's no cash inflow. But for the cost, when the sales is made, there is a cost goods sold, right? Because you spent money to buy that product. So that is a solid cost being added in there. So here are some examples for our personal finance, just in case you graduate and begin to work and get paid. So you will see your net pay is right here, and you need to deduct all your rents and car payments, and also you may save some money and earn some interest per month, and you also have a miscellaneous spendings. So this would be your inflows and outflow. So you want to make sure you have a positive inflow, otherwise you would be drawn in debt. And for the financial activities, there are not too much to mention anymore. So just remember, many of the financial topics are derived from accounting topics. Just like the balance sheet, you have current assets, fixed assets for the assets part, and the current liabilities and long-term funds for the financing part. So that basically determines what kind of decisions you will make, either make financing decisions or investment decisions, and how to do that. So we're gonna spend more time on this topic in later chapters.